You didn't have a savings account. Banks didn't want you, and the ones that did made you feel small for walking through the door. Nobody explained how to build wealth without credit. It didn't need explaining. You watched it happen at the kitchen table. The tin on the shelf nobody touched without asking. The dime handed over every week so a funeral never became a crisis. The penny turned into a dollar, then into a bank, then into a whole street of businesses nobody outside the family ever financed. Nothing here came from a textbook. It came from people who decided, over and over, that they would never owe anybody anything they couldn't pay back. This is how it was done. Lesson 1. The partner hand. You didn't have a savings account. Banks didn't want you, and even if they let you in, the line was long, the smile was thin, and the rules were never built with you in mind. So you built your own bank. It lived inside your circle of family and friends, and it was called the partner hand, or the susu. Here is how it worked. You picked a small group of people you trusted completely. Could be 5 people, could be 12. Everyone agreed on one number, say $20. Every single week, or every payday, each person put that same $20 into one pot. No more, no less. Then, on a set schedule, one person in the group took home the whole pot. Next week, somebody else got the whole pot. This kept going until every single person had their turn. Nobody got left out. Nobody got skipped. Think about what that actually means. If you were the first person to receive the money, you just got a big sum of cash way faster than you could have saved it alone. If you were the last person to receive it, you basically forced yourself to save all year, because that money was already promised to the group, and you could not touch it early. Either way, you came out ahead of where you started. There was always one person running the whole thing. Sometimes she was called the banker. Sometimes people just called her the one who held the book. Her job was simple but heavy. She kept track of who paid, who was due next, and how much was in the pot. There was no paperwork, no bank teller, no computer, just her memory, maybe a notebook, and her word. And here is the part that made the whole thing actually work. There was no contract, no lawyer, no interest charged to anyone. If you took your turn early, you didn't owe extra. If you took your turn late, you didn't earn extra. The entire system ran on one thing only, and that one thing was trust. If you skipped your payment, you weren't just letting down a bank. You were letting down your aunt, your neighbor, your coworker, somebody who saw you at church on Sunday. That kind of pressure kept almost everybody honest. This practice didn't start in America. It came from West Africa, where it was called esusu, among the Yoruba people. When West Africans were brought across the ocean during slavery, this saving system traveled with them. In Trinidad, people called it susu. In Jamaica, they called it partner, or throwing a hand. Each island had its own name, but the rules stayed close to the same. By the time the practice reached black communities in cities like New York, it had become a quiet, everyday tool. In some Caribbean immigrant neighborhoods in the 1980s, researchers found that roughly 3 out of every 4 households were part of one of these rotating groups. That is not a small habit. That is a whole financial system running underneath the official one, invisible to the banks, completely visible to everybody who needed it. Some banks eventually noticed. A few in New York started accepting proof that someone had faithfully paid into a partner hand for years as a kind of credit reference, since it showed the person paid on time, every time, without fail. The system built outside the bank ended up proving something the bank's own paperwork couldn't. But the deepest value of the partner hand was never just the money. It was the proof that you didn't need permission from anybody to build something solid. You needed people. You needed your word. You needed a notebook and a little bit of trust, passed hand to hand, week after week, until everybody had their turn. There was another tin on the same kitchen shelf, though. This one didn't move. It didn't rotate. It just sat there, filling up slowly, week after week, and it had a job of its own. Lesson 2. The tin on the shelf. You kept a tin on the kitchen shelf, and everybody in the house knew not to touch it. It might have been an old coffee can, a cookie tin, or a cigar box. It didn't matter what it used to hold. What mattered was what it held now. Cash. Folded bills and loose coins, dropped in a little at a time, week after week. This wasn't about distrust for no reason. It came from real history. In 1865, right after the Civil War, the federal government set up a bank just for formerly enslaved people. It was called the Freedmen's Savings Bank. Black families across the South trusted it with their money, sometimes their entire life savings, because the government backed it. By 1874, that bank had collapsed. Mismanagement and bad loans by the bank's own white trustees wiped out the deposits. Depositors got back only a fraction of what they had put in, and some got back nothing at all. That collapse wasn't a small local story. It touched tens of thousands of black families and became one of the most painful financial lessons passed down through generations. So the lesson that followed wasn't complicated. If the bank can fail and take your money with it, keep some of your money where you can see it. Keep it where no teller, no manager, and no government decision can touch it without your hand being the one that moves it. This habit didn't stay stuck in 1874. For decades after, plenty of black families across the country still faced banks that wouldn't open an account for them at all, especially in the South under Jim Crow. Even where a bank would let you walk in the door, the service was often slower, colder, and came with more suspicion than it gave anybody else standing in that same line. When an entire system keeps finding reasons to make you wait, you stop waiting on it. So the tin became the answer. It sat in a kitchen cabinet, under a floorboard, inside a sugar canister, or tucked behind the cereal box. Every house had its own version, and every house had its own hiding spot, usually known only to the one person who managed the money. The tin had rules, even if nobody ever wrote them down. You didn't dip into it for something small. You didn't tell every visitor it existed. And you definitely didn't touch another family member's tin without asking, because that money wasn't just cash. It was somebody's protection against a bad week, a broken stove, or a funeral nobody saw coming. Some families split their saving into more than one container. One tin for the light bill, one for rent, one that nobody touched at all, kept only for real emergencies. This wasn't fancy bookkeeping. It was just common sense passed down by watching your mother or grandmother do it the same way every single payday. There's a reason this habit held on so long after banks became more open to black customers in the later 20th century. Trust, once broken at that scale, doesn't rebuild itself just because the rules changed on paper. Grandparents who lived through redlining, through being turned away from a loan officer's desk, through watching a bank account get frozen or a loan get denied for reasons that were never fully explained, passed that caution down the same way they passed down a recipe. Not as a lecture, just as the way things were done. And there was a quiet kind of power in it too. With the money sitting right there in the house, you could see exactly how much you had left for the week. You could touch it, count it, and know without checking a statement whether you could afford something or not. There was no overdraft fee waiting to surprise you, no monthly charge quietly chipping away at the total while you weren't looking. What you put in is what stayed in, dollar for dollar, until you decided otherwise. This wasn't about hiding money out of fear. It was about control. Control over what happened to your own savings, control over who could touch it, and control over knowing exactly where you stood financially at any given moment, day or night, without needing anybody's permission to check. By the time a lot of these grandparents were raising their own grandchildren, they still kept some cash at home, even after they had a full bank account with their name on it. Old habits built from hard lessons don't disappear just because the danger that created them has eased. They just become part of how a family runs its money, generation after generation, whether anyone ever explains why out loud or not. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That tin sitting quietly on the shelf wasn't the only thing protecting the family, though. Down the street, there was another kind of saving going on entirely. One that didn't involve a single dollar sitting still at all, but a whole group of neighbors making sure nobody's funeral went unpaid. Lesson 3. The Burial Society. Nobody wanted to talk about dying, but everybody knew you had to plan for it anyway, because a funeral cost money, and money never showed up on cue just because somebody passed. So Black communities built their own answer to that problem, long before anyone called it insurance. It was called a burial society, sometimes a benevolent society, sometimes just the lodge. You paid a small amount, maybe a dime or a quarter, every week or every month, into a shared fund. In exchange, when you died, your family didn't have to scramble. The society paid for the coffin, the plot, the preacher, and the gathering afterward. This system goes back further than most people realize. In 1787, in Philadelphia, two free Black men, named Richard Allen and Absalom Jones, started the Free African Society. It wasn't a church, and it wasn't a bank. It was something in between. Members paid dues, and those dues covered burial costs, helped the sick, and supported widows and children left behind. That single organization ended up planting the seed for the African Methodist Episcopal Church. But its first job was simpler than any of that. Its first job was making sure nobody got buried without dignity just because they died poor. After the Civil War, this idea spread fast. Formerly enslaved people, many of them with no land, no inheritance, and no access to a regular bank, built lodges and societies across the South and North. Two of the biggest were the Independent Order of St. Luke and the United Order of True Reformers, both founded by people who had once been enslaved themselves. Both organizations started out focused mainly on one thing: making sure sickness and death didn't bankrupt a family on top of everything else they were already carrying. The Grand United Order of Odd Fellows was another one of these groups, and it actually had Black members before the original British version of the Odd Fellows ever accepted them. By the 1850s, the order had grown to over 1,000 members, spread across more than 20 lodges, stretching from the eastern seaboard all the way down to Bermuda. The benefits weren't flashy. They covered burial costs, helped during sickness, supported people who couldn't work because of injury, and looked after widows. But for families with nowhere else to turn, that kind of support was the difference between falling apart and holding together. Here's why this mattered so much. Regular insurance companies in that era either refused to sell policies to Black families at all, or they sold them policies that cost more and paid out less than what white families got for the same money. So the burial society wasn't a backup plan. For a lot of families, it was the only plan that actually existed. The way these societies ran was simple and steady. Somebody collected the dues, usually going door to door or meeting people after church. That money got pooled together and held until it was needed. When a member died, the society stepped in immediately. No long forms, no waiting weeks for an insurance adjuster to approve a claim. The community had already done the work of trusting each other long before the death ever happened. Membership in these lodges wasn't only about money either. The Grand United Order of Odd Fellows, the Prince Hall Freemasons, and groups like them gave people something else that was just as valuable. They gave people a seat at a table where they mattered. A lot of Black leaders of that era, the kind who later led churches, ran businesses, or pushed for civil rights, got their start by learning how to lead inside one of these lodges. Running a burial society meant learning how to manage money, keep records, settle disputes, and look out for people who depended on you. Those were the exact skills that later built bigger institutions. By the late 1800s and early 1900s, scholars estimate that roughly 1 in 3 American men belonged to some kind of fraternal organization, and Black membership in these societies was especially high, since they often had fewer other options for support. W.E.B. Du Bois, writing around the start of the 20th century, pointed directly at these mutual aid societies as proof of something important. He saw them as evidence that Black communities had already built their own systems of strength and economic independence, long before anyone outside the community gave them credit for it. These societies eventually faded as government programs like Social Security and workers' compensation expanded, and as commercial insurance companies finally started selling real policies to Black customers. But for close to 100 years, The Burial Society was the quiet machine running underneath Black community life, making sure death never meant total financial ruin for the people left behind. And once the burial was handled and the dues were paid, there was still the question of where the family would actually gather every single Sunday, because that building wasn't free either, and paying for it took its own kind of weekly discipline. Lesson 4. The Building Fund Envelope. Every Sunday, a small envelope made its way around the church. Most people already know what the regular collection plate was for. But there was a second envelope, separate from the regular offering, and that one had a different name on it. Building Fund. Or sometimes, just New Building. That envelope wasn't about keeping the lights on for the week. It was about something much bigger. It was about buying land, paying off a mortgage, or finishing construction on a sanctuary that the whole congregation was building together, $1.25 at a time. This kind of saving had deep roots. After Richard Allen and Absalom Jones started the Free African Society in Philadelphia in 1787 to help with burial costs and aid for the sick, that same group of people went on to found the African Methodist Episcopal Church, the first independent Black church denomination in the country. Richard Allen put it plainly when he talked about why a separate church was needed at all. Black worshippers needed a place where they could gather without fear and without being pushed to the back. And that kind of place had to be built and owned outright, not borrowed or granted as a favor. Owning the building mattered, because so much else in a Black family's life back then could be taken away, denied, or controlled by somebody else. A landlord could raise the rent, a bank could deny a loan, a job could disappear without warning, but a church building, paid for fully by the people who worshipped inside it, belonged to nobody else. No outside board could shut its doors. No white-run bank could foreclose on it, for reasons that had nothing to do with money owed. So the building fund became one of the most disciplined savings habits in Black community life. It worked a lot like the Burial Society from before, except the goal wasn't insurance against death. The goal was construction, brick by brick, paid for in small amounts collected from people who mostly didn't have much extra to give in the first place. Here's what made it work. Everybody contributed something, even if it was small. A grandmother might put in 50 cents some weeks and $1 on others, whatever she could manage after rent and food were covered. A working father might add a little more on payday. None of these amounts were large on their own, but multiplied across an entire congregation, week after week, year after year, that money eventually became enough to pay off land, hire a builder, or finish a roof that had been sitting half done for months. The pastor or a trusted deacon usually kept the books, the same way the banker kept the books for a partner hand, or the way a burial society treasurer tracked who had paid their dues. There was no outside lender involved most of the time, no interest charged to the congregation, because the congregation was lending the money to itself. This habit produced something that lasted far beyond any single building. The African Methodist Episcopal Church, born out of that original mutual aid society in Philadelphia, grew into one of the largest Black-led religious organizations in the country, with congregations built the same patient way all across the South and North. Each one of those buildings represented years, sometimes decades, of small weekly contributions from people who had almost nothing extra, given anyway, because the goal mattered more than the inconvenience. The church building itself often became more than a place for Sunday service once it was finished and paid for. It turned into the headquarters for everything else the community needed. Mutual aid meetings happened there. Burial society dues got collected there. Later on, civil rights organizing happened inside those same walls, because the church was one of the only spaces fully owned and controlled by Black communities themselves, free from outside permission or outside debt. That ownership was the entire point. A rented hall could be taken away the moment rent went unpaid for one bad month. A borrowed space came with somebody else's rules attached. But a building paid for fully through small, steady contributions belonged completely to the people who built it, and nobody could take it back over a missed payment, because there was no payment left owed to anybody. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. This same pattern, small contributions adding up to outright ownership, didn't stay limited to church buildings either. It showed up again in a much bigger and bolder form when one woman in Richmond, Virginia, decided that her community didn't just need a building, it needed its own bank. Lesson 5. Pennies into dollars. In 1903, in Richmond, Virginia, a woman named Maggie Lena Walker did something nobody had recorded a black woman doing before. She opened a bank, not just worked at one, not just deposited money into one. She founded it, owned it, and ran it as president, becoming the first black woman in the United States to charter and lead a bank of her own. Her mother had been born enslaved and spent her life working as a laundress. Maggie grew up watching her mother's hands raw from washing other people's clothes, and she grew up determined that her community needed something nobody could take away from it. Not a job working for somebody else, an institution that belonged to black people, run by black people, built to serve black families who had nowhere else to turn. She had joined a fraternal organization called the Independent Order of St. Luke when she was just 14 years old. By the time she took over its leadership in 1899, the order was nearly broke. It had lost most of its members, and the treasury held only $31 while owing almost $400 in debt. Within 1 year, Walker had doubled the membership and rebuilt the treasury. She wasn't just good with people, she was good with numbers, and she used both skills to build something much bigger than one struggling lodge. In 1901, she stood in front of the order and laid out her plan. Her words that day still get repeated more than a century later. "Let us put our monies together," she said. "Let us put our money out at usury among ourselves and reap the benefit ourselves. Let us have a bank that will take the nickels and turn them into dollars." That last line wasn't just a slogan. It described exactly what she intended to build, a bank for people whose entire savings might be a few coins at a time. On November 2, 1903, the St. Luke Penny Savings Bank opened its doors inside the Order's headquarters in Richmond's Jackson Ward neighborhood. On that very first day, 280 customers walked in and deposited more than $9,000 combined. The amounts ranged from 31 cents to over $400. 31 cents. That single deposit tells you everything about who this bank was built for. It wasn't built for people who already had money sitting somewhere else. It was built for people who had never been allowed to walk into a bank and be taken seriously with whatever small amount they carried in their pocket. The bank did things differently from the white-owned banks of that era, on purpose. Most banks back then wanted half the cost of a home paid up front before they would even consider a mortgage, and they wanted it paid back within 5 years. Walker's bank accepted down payments as low as 10%. She made loans as small as $5, an amount most banks wouldn't have bothered processing the paperwork for. By 1920, Walker said her bank had helped 645 black families pay off their homes completely. She didn't stop with adults either. Walker handed out small cardboard and coin banks to children across Jackson Ward and told them to start saving their pennies. Once a child had saved a full dollar, they could open their own account at her bank. Some of those children, by her own account, grew their savings to somewhere between $100 and $400 over time, money that belonged entirely to them, earned and saved 1 penny at a time, with their name on the account. Walker also required employees at her bank to save 5% of their own wages, treating the habit of saving as something you build into your life on purpose, not something you do only when there happens to be money left over. She believed that if her staff didn't practice what the bank preached, the whole mission meant nothing. By 1924, the bank had grown to serve more than 50,000 members across Virginia. Then came the Great Depression, when banks all across the country collapsed by the thousands, wiping out the life savings of millions of Americans almost overnight. Walker's bank survived. While other institutions failed around her, she steered St. Luke Penny Savings Bank through the crisis and orchestrated mergers with 2 other struggling black-owned banks, forming the Consolidated Bank and Trust Company. That merged bank didn't just survive the Depression. It went on to become the oldest continuously operating African-American-run bank in the entire country, lasting all the way until it was eventually absorbed into a larger banking company in 2005. Think about what that means. A bank built on pennies and 31-cent deposits outlasted institutions built on millions of dollars from people who had never once been turned away at the door. Walker proved something that the entire banking system of her era had refused to believe. She proved that people with almost nothing could be trusted to build something permanent, as long as somebody was finally willing to take their nickels seriously. But owning a bank wasn't the only kind of ownership that mattered to families trying to build something lasting. For a lot of grandparents, the real prize wasn't a bank account at all. It was a piece of dirt with their name on the deed, something no landlord and no bank could ever take back over a missed rent payment. Lesson 6. Land was the whole goal. In January 1865, near the end of the Civil War, a group of black ministers in Savannah, Georgia, sat down with Union General William T. Sherman and Secretary of War Edwin Stanton. They were asked directly what freed people needed most. Their answer came through their spokesman, a Baptist minister named Garrison Frazier. He said the way they could best take care of themselves was to have land, work it with their own hands, and build something they could call their own. 4 days later, Sherman issued Special Field Order 15. It set aside 400,000 acres of land along the coast of South Carolina, Georgia, and Florida, broken into 40-acre plots for newly freed families. Mules used by the Army were later promised too, which is where the phrase 40 acres and a mule came from. By June of 1865, around 40,000 formerly enslaved people had settled on this land, building homes, planting crops, and finally working soil that belonged to nobody but themselves. It didn't last. Within months, President Andrew Johnson, who had owned enslaved people himself before taking office, reversed Sherman's order completely. The land was handed back to the same Confederate planters who had lost it. Families who had already built homes and planted fields were forced off, sometimes by federal troops. On Edisto Island, freed people sent a petition straight to President Johnson, telling him plainly that the land was their home, that they had toiled there nearly their whole lives, and that they had made the land what it was, with their own labor. It didn't matter. The land went back to the old owners anyway. So the promise broke. But here's what didn't break. The desire for land never went away, and black families kept chasing it anyway, this time without any government order to lean on. They bought it themselves, piece by piece, through private deals, savings, and sheer determination. By 1900, 1 out of every 4 black farmers in the South owned the land they worked. That number kept climbing. By 1910, black Americans owned around 15 million acres of land across the country, most of it concentrated in Alabama, Mississippi, North Carolina, and South Carolina. At that same point, black families owned roughly 1 million farms, making up about 14% of all farms in the entire United States. That happened during some of the harshest years of Jim Crow, while laws were actively being written to keep black families poor and powerless. Some of this land came through extraordinary effort. In Georgia, a minister and politician named Tunis Campbell bought 1,250 acres from white planters and divided it up to sell directly to black families, building an entire farming community from nothing but his own purchase. In Texas, freed people built entire towns of their own from scratch, places that came to be called freedom colonies, built because no one else would let them settle anywhere else. Why did land matter this much? Because land couldn't be fired from a job. It couldn't be evicted by a landlord on a whim. It couldn't disappear if a factory shut down or a white employer decided he didn't feel like paying you that week. Land sat there, season after season, and it grew food, whether the rest of the world cooperated with you or not. And unlike cash, which could be spent in a week, land could be handed down to your children, and then to their children after that. That's exactly what families tried to do. A father who owned 40 acres wanted his son to inherit those same 40 acres, and his son's children after him, so the family never started from zero again. But owning the land turned out to be only half the battle. Keeping it across generations turned into its own enormous struggle. Many black landowners in this era, having grown up under a legal system that had treated them as property rather than people, deeply distrusted lawyers, courts, and official paperwork. So a lot of land got passed down the simplest way families knew, through word of mouth, with no formal will ever written down. That land became what's known as heirs' property, owned jointly by every descendant whether they wanted a piece of it or not, with no single clear owner on paper. All it took was one distant relative selling their tiny fractional share to an outside buyer, and the entire family could be forced to sell the whole property at auction, sometimes for a fraction of what it was worth. Add to that the violence, the fraud, and the discrimination at banks and government loan offices that often denied black farmers the credit white farmers got without a second glance. And the math turned brutal. From that 1910 peak of 15 million acres, ownership fell to about 5.5 million acres by 1980, and down to roughly 2 million acres by 1997. The land that took so much sacrifice to win in the first place slipped away decade after decade, piece by piece. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. And that loss is exactly why something else became so important inside black households that did manage to hold on to land, or that never had the chance to own any in the first place. If the land itself could be threatened by a missing piece of paper, then the food coming out of the ground around the house had to be protected a different way entirely, starting with what got planted in the backyard every single spring. Lesson 7. The Garden and the Hog. Cash was scarce, but a family didn't need cash to eat if they grew and raised their own food right outside the door. So almost every family kept a garden plot, a few chickens, and at least one hog, treating food the same way they treated savings. Build it up all year so you never come up empty when you need it. The garden ran on a calendar nobody had to write down. Spring meant planting. Summer meant growing and harvesting. Late summer and early fall meant something else entirely. It meant canning, and canning meant work that didn't stop until winter's food was locked safely inside glass jars. One sharecropper's wife from the 1930s described late summer canning as the hardest time of a woman's whole year. She wasn't exaggerating. Canning meant standing over a hot stove for hours, on top of tending the garden, on top of whatever fieldwork still needed doing that same day. The heat from the canning fire stacked right on top of the regular August heat, and there was no air conditioning waiting to cool the kitchen down afterward. But plenty of women who lived through it didn't describe it only as suffering. One woman, interviewed decades later about her canning seasons, said she loved it outright. She said canning was all she wanted to do, that she could stay in that kitchen from morning to night, putting up beans, blackberries, figs, and jelly, as long as she had jars and good lids to seal them with. Her family ended up buying almost nothing from the store except meat, lard, sugar, coffee, cornmeal, feed for the animals, and jar lids. Everything else, the family grew, raised, or canned themselves. That's the real number worth sitting with. Almost nothing from the store, except a short list of items that couldn't be grown in a backyard. Everything else came from the family's own labor, stored in jars lined up on shelves, enough to carry a household clear through winter, without spending a single extra dollar at the grocery counter. The hog mattered just as much as the garden, maybe more. Killing a hog wasn't a quiet, private chore. It was a full community event. Men caught the hog, killed it, and butchered it, usually working together across several families, rather than each household handling it alone. Women and children then took over the next stage, turning the meat into sausage, salting strips of it down for preservation so it would last through the coming months, and rendering the fat into lard, which became the household's main cooking oil for the entire year. One family later remembered they killed their hogs around Thanksgiving, and from that single hog they got all the lard they needed, what people back then simply called lard, and what most people today would call cooking oil. The only things that family bought heading into winter were flour, grits, and cornmeal, items that couldn't be raised on the farm itself. This wasn't a hobby or a tradition kept for flavor. It was survival math, plain and simple. A family living on a sharecropper's wage, sometimes earning as little as $3 a day for a full day of fieldwork, could not afford to buy meat, milk, and vegetables from a store every single week. So they made sure the farm itself produced those things directly. Chickens and cows supplied eggs and milk. The garden supplied vegetables straight through summer, and, once canned, straight through winter too. The hogs supplied meat and lard that lasted for months past the actual day it was killed. Even the wrapping survived, nothing wasted. When landowners bought feed for their animals, that feed often came packed in white cloth sacks. Families would wash those sacks out and sew them into underskirts and clothing, because cloth wasn't something you bought new if you could avoid it. One woman who grew up sharecropping in North Carolina remembered her family doing exactly this, turning feed sacks into clothing her sisters wore to school all winter long. None of this came from a lack of effort or a lack of skill. It came from a system built to keep sharecropping families with almost no cash in hand, no matter how hard they worked the fields. The landowner kept the books, set the prices at settlement time, and controlled most of the money a family's labor actually earned. So families built their entire food supply outside of that money system completely. If the man controlling your wages controlled how much cash reached your kitchen table, the answer was simple: make sure the kitchen table didn't depend on cash in the first place. That same instinct, take care of your own needs so nobody else holds power over your survival, didn't stop at food. It carried straight through to how families dressed their children, stitched their bedding, and made sure nothing with any use left in it ever got thrown away, starting with a stack of old, worn-out clothes that got a second life entirely. Lesson 8. Old clothes had one more job to do. Nothing got thrown away just because it was worn out. A pair of work pants with the knees blown through, a dress with a stain that wouldn't come clean, a flour sack emptied of its last cup of flour. None of it went in the trash. It went into a basket, waiting to become something else entirely. That something else was a quilt. In a place called Gee's Bend, Alabama, a small community of black women, all descended from people enslaved on the same cotton plantation, built one of the most remarkable quilting traditions in American history. It started in the 19th century for the plainest reason possible. Their homes had no heat, no running water, and no electricity, and the winters got cold enough that a family needed every blanket it could get its hands on. Quilting wasn't a hobby in that house. It was how a family stayed warm enough to sleep through the night, so the women took whatever fabric they already owned and gave it a second life. Old work clothes, denim overalls worn thin from years in the cotton fields, dresses too faded or too torn to wear in public anymore, and feed sacks, the cloth bags that animal feed, flour, and fertilizer came packaged in, washed clean and cut apart once they had served their first purpose. One quilter named Betty Bendolph Seltzer remembered her mother making quilts strictly from old clothes, pants, fertilizer sacks, dress tails, and meal and flour sacks. "That's it," she said. "That's all there was to work with, and that's all anybody needed." Here is what made these quilts different from most other quilting traditions in the country. The women of Gee's Bend rarely followed a printed pattern from a newspaper or a magazine. Most other quilters of that era worked from set designs, repeating the same exact pattern someone else had already drawn up. The women of Gee's Bend did it their own way instead, locally calling their approach simply "My Way Quilts." One quilter, Annie Mae Young, explained it plainly. She said she never liked the book patterns other people used. She worked it out herself, studying how to make it right, the same way you'd work through a puzzle. That meant every single quilt came out different, shaped entirely by whatever scraps happened to be sitting in the basket that week. A pair of jeans might end up next to a piece of a church dress. A flour sack might sit beside a strip cut from a worn-out work shirt. The quilters built compositions out of whatever they actually had, not what a pattern told them they were supposed to have, which is exactly why no two quilts ever looked the same. This skill passed from mother to daughter for generation after generation, inside the very same families, for well over 100 years straight. Mary Lee Bendolph learned quilting from her own mother, Eola Carson Mosley, and later taught the same techniques to her daughter, Essie Bendolph Petway. 3 and sometimes 4 generations of women from a single family, all making quilts across the decades, is something almost nobody else in American craft history can claim. Nobody had to write a manual, A daughter learned by watching her mother's hands move, the same way she learned to cook or to can vegetables, just by being present and paying attention. There was meaning stitched into the materials too, not just the design. Mary Lee Bendolph once said that old clothes have a spirit in them. A pair of pants a father wore every single day in the fields. A dress a grandmother wore to church for 30 years straight. Those clothes carried the memory of the person who wore them. Turning that fabric into a quilt meant that memory kept covering the family at night, long after the original clothing had worn through completely. This wasn't only about staying warm either, even though that need came first and never stopped mattering. A quilt represented hours upon hours of a woman's labor, given freely to her own household after whatever paid or unpaid fieldwork had already worn her out for the day. It meant nothing in that house got wasted, not a scrap of fabric, not a worn-out feed sack, not a single hour a woman had left over once the rest of her work was done. In 1966, during the Civil Rights era, the women of Gee's Bend turned this exact skill into something new. They formed a cooperative called the Freedom Quilting Bee, selling their quilts to buyers outside the community for the first time, turning a skill born purely out of necessity into actual income for their families. Decades later, museums across the country, including the Whitney Museum of American Art and the Smithsonian, began hanging these same kinds of quilts on their walls as serious works of art. The materials were always the same humble scraps. What changed was the world finally noticing what these women had been building out of nothing for over 100 years. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. But a quilt could only keep a family warm. It couldn't put a roof over their heads in the first place, and getting that roof paid off completely, free and clear, without owing the bank a single dollar more, was its own kind of battle that played out in households all across the country, one extra payment at a time. Lesson 9: The house that could not be taken back. When a black family finally got the keys to a house, paying that mortgage off completely became its own kind of mission. Not someday, not eventually, as fast as humanly possible, because owning that house outright meant nobody, ever, could come take it back. To understand why that mattered so much, you have to understand how hard it was to get that house in the first place. In 1934, the federal government created the Federal Housing Administration to help Americans buy homes after the Great Depression had wiped out so many families' savings. The FHA agreed to back, or insure, home loans, which made banks much more willing to lend money for 30-year mortgages instead of demanding the entire price up front. But that help almost never reached black families. The FHA's own underwriting manual in 1938 warned lenders directly about what it called the infiltration of inharmonious racial groups, treating the simple presence of black residents as a reason a neighborhood could lose value. Government workers drew maps of cities all across the country, coloring entire neighborhoods red if black families lived there, marking those areas as too risky for any bank to lend in. That's where the word redlining comes from, those actual red lines drawn on actual maps. Between 1934 and 1962, the federal government backed $120 billion in new housing loans. Only 2% of that money went to non-white families. 2% out of $120 billion. So if you were a black family trying to buy a home during these decades, you were almost never getting the same low down payment, low interest, federally backed loan that white families were getting. You were getting turned away outright, or you were paying far higher rates through whatever private lender was willing to take the risk the government refused to insure. Every dollar of that mortgage cost more, every month, simply because of where you were born and what you looked like. That's exactly why, once a family finally did get a house, paying it off as fast as possible wasn't just a financial preference. It was protection. A mortgage you still owed money on meant a bank still had a claim on your house. Miss enough payments, and the bank could take it back, no matter how many years you had already lived there, no matter how much of your life you had poured into that address. But a house paid off in full belonged to you, completely, with no lender holding any piece of it anymore. So families treated extra income as a weapon against the mortgage balance, not as money to spend somewhere else. A small bonus from work, money from selling extra vegetables out of that backyard garden, anything left over after the bills got paid. It went straight at the principal, shrinking the number of years left on that loan, sometimes by months at a time, sometimes by years if the extra payment was big enough. This urgency made even more sense once you understood what was happening to entire black neighborhoods. At the same time, families were trying to hold on to their own homes inside them. Government maps had already decided which neighborhoods deserved investment and which ones didn't. Banks followed those maps for decades. So even after a family paid off their own house completely, the value of that house often grew much more slowly than homes in neighborhoods the government had marked as safe to invest in. One major study found that homeowners in formerly redlined neighborhoods built 52% less wealth from rising property values over 40 years, compared to homeowners in neighborhoods the government had favored from the start. Knowing that, paying off the mortgage fast wasn't just about avoiding foreclosure. It was about making sure the house, once it was finally yours outright, became something solid you could actually pass down, free and clear, to your children. A house with a mortgage still attached could be lost in one bad year if a job disappeared or a medical bill hit hard. A house paid off in full could sit there for decades, belonging to the family no matter what storm came through next, ready to be handed down the same way land had once been handed down by grandparents who never got the chance to own much else. The Fair Housing Act finally banned this kind of discrimination outright in 1968, but by then, decades of denied loans and undervalued neighborhoods had already shaped where black families lived, how much their homes were worth, and how much wealth those homes could ever realistically pass down. Paying off a mortgage early couldn't undo any of that damage at a national level. But inside one single household, it meant something concrete and unshakable. It meant that whatever else the world outside that front door tried to take, the roof over your family's head was never up for grabs again. That same hunger to own something completely, free of anybody else's claim on it, didn't stop at the house. It showed up just as strongly at the Sunday dinner table, where an entire extended family pooled what little they had to make sure nobody in that family ever sat down to an empty plate. Lesson 10. Everybody owed everybody. And that was the point. In the late 1960s, a young researcher named Carol Stack moved into a poor black neighborhood in the Midwest, a place she called the Flats, to protect the privacy of the families living there. She wanted to understand how people survived on almost no steady income, with jobs that came and went, and a welfare system that barely covered the basics. What she found wasn't broken families. She found one of the most organized economic systems most people had never noticed was happening right in front of them. She called it the exchange network. Here's how it worked. If your refrigerator broke and you had no money to fix it, you didn't go without. You asked a cousin, an aunt, a close friend, somebody in your network, and they helped, because you had helped them with something else before, and you would help them again with something else later. Nobody kept a strict written ledger. Nobody charged interest, but everybody understood, deep down, that help given today created an obligation that would get repaid eventually, in whatever form was needed, whenever it was needed. One woman Stack interviewed put it about as plainly as anybody could. You have to have help from everybody and anybody, she said. The poorer you are, the more likely you are to pay it back. That second part is the piece most outsiders missed completely. People assumed poverty meant nobody could be relied on. The truth was closer to the opposite. The less money any single person had sitting in reserve, the more that person needed a whole network of people they could call on, and the more seriously everybody took their turn to give back when somebody else was in need. Stack watched this play out constantly around something as basic as Sunday dinner. A family rarely cooked that meal entirely on its own money. One relative might bring meat, another might bring vegetables from her own garden. Somebody else might show up with the cornbread or the dessert, or simply extra hands to help in the kitchen. The cost of feeding a large extended family got spread across every household connected to it. instead of landing entirely on whoever happened to be hosting that particular week. This wasn't only about food, though food was often where it showed up most clearly. Stack documented families sharing clothing, furniture, small amounts of cash, and even childcare across this same network. If a mother needed to work a shift and had nowhere for her children to go, an aunt or a grandmother stepped in, without being asked twice. The same way that mother would step in for somebody else's children the following week. Raising kids wasn't treated as one household's job alone. It was treated as something the whole extended network shared responsibility for, with care moving back and forth between relatives, depending on who needed help and who had the time to give it that particular day. Why did this system work at all, when nobody had much money to begin with? Because the thing being exchanged wasn't really money. It was trust, built up slowly over years, transaction by transaction, favor by favor. If you took help and never gave any back when your turn came, people noticed. Your name started carrying less weight inside the network. But if you showed up reliably, again and again, contributing whatever you had whenever somebody else needed it, you became someone the whole extended family could lean on, and someone the whole extended family would lean toward helping first, when your own turn for hard times came around. Stack's research came out right after a 1965 government report had claimed the black family structure in America was falling apart, broken, and dysfunctional. Her 3 years of direct, on-the-ground observation told a very different story. What she actually found was a complex, highly organized system of mutual support, built specifically to survive chronic unemployment, low wages, and a welfare system that often punished people for having too much family support in the first place. The families she studied weren't failing to build stable structures. They had built an entirely different kind of structure, one that ran on obligation and reciprocity, instead of bank accounts and savings statements. And it had been quietly keeping families fed, housed, and cared for the whole time. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. This same instinct, lean on the people around you and expect to be leaned on in return, didn't disappear once a family member packed a bag and moved somewhere else entirely, looking for better work. If anything, the network just stretched further, reaching all the way from a kitchen table in the rural South to a paycheck earned hundreds of miles away in a factory up north, with a portion of that very paycheck finding its way home before the worker who earned it had even finished unpacking. Lesson 11. One ticket north, one job, money for everybody left behind. Between 1910 and 1970, around 6 million black Americans packed up and left the South, heading north, Midwest, and west, chasing factory jobs, fair wages, and a chance to live without the constant threat of Jim Crow hanging over their heads. Historians call this the Great Migration, but for the families involved, it wasn't really about one person leaving. It was about one person going first, so the rest of the family had somewhere to land later. The Chicago Defender, a black newspaper, became a major part of how this whole movement spread. The paper printed advertisements for jobs and published letters from migrants who had already made the move north, describing higher wages and less discrimination than what they had left behind. People read those letters out loud in barbershops, in churches, in meeting halls, passing the information from person to person across entire communities still living under sharecropping contracts and Jim Crow laws. But moving north took money most families simply didn't have lying around. A family of 4 traveling by boat from Virginia to New York in the 1920s might pay around $25 total. Train fare from Virginia to New York ran about $7.50 per person. For a family scraping by on sharecropper wages, sometimes earning as little as $3 a day, that kind of money took real saving to gather, and it usually meant sending one person ahead first, while everyone else stayed behind and kept working. So that's exactly what happened, over and over, across thousands of black families. A husband, a son, sometimes a daughter, would travel north alone first. One sharecropper from Moundville, Alabama, settled up whatever debt he owed, packed his clothes into a single sack, and left his wife and 6-month-old son behind to travel to Michigan, where his brother had already moved. It took him a full year of working and saving before he could finally send for his wife and child to join him. Once that first family member landed a job up north, the money didn't stay only in their own pocket. A portion of almost every paycheck got sent right back south, to the relatives still waiting and still working the same fields the migrant had just left behind. This wasn't a one-time gift. It became a regular, expected part of family life, the same way rent or groceries were expected. The person who had migrated north sent money home so the family back south could pay bills, buy seed for the next planting season, or eventually save enough to make the trip north themselves. Families also banded together before anybody even left, forming what historians call migration clubs. Groups of relatives and friends would pool their money together, buying train tickets in bulk at reduced group rates, and then traveling north together in a pack rather than scattering off alone one at a time. The same instinct that built a partner hand or filled a church building fund showed up here too. Spread the cost across everybody who benefits, and the whole group moves further than any single person could move on their own. The letters moving between north and south carried more than just news. They carried real financial planning. A migrant who had settled into steady factory work in Chicago or Detroit might write home, describing exactly how much a job paid, how much rent cost, and how much money was left over once the bills were handled, giving the family back home enough real information to decide whether the next person should make the trip, and roughly how much money they would need saved before doing it. This back-and-forth flow of money didn't slow down once a family fully relocated north either. Many migrants kept sending money south for years afterward, supporting parents, grandparents, or extended relatives who had chosen to stay in the south, near the land or the church community they had built their whole lives around. The family had physically split apart across hundreds of miles, but the financial responsibility for each other never did. This pattern, leave first, work hard, send money home, bring the rest of the family later, repeated itself across millions of individual stories throughout the entire Great Migration. It wasn't charity flowing in one direction. It was an entire family treating migration itself as a shared financial project, with everybody contributing whatever piece they could manage, whether that meant saving for the ticket, working the fields back home a little longer, or sending dollars north to south once that first job finally came through. That same discipline, treating money as something that belonged to the whole family rather than to whoever happened to be holding it that week, eventually grew into something even bigger in some northern black neighborhoods. People who couldn't walk into a regular bank found another way entirely to turn their small weekly contributions into real investment money, running an entire informal economy that the banks downtown never even knew existed. Lesson 12: The Numbers. Every morning in Harlem during the 1920s, an employee at the New York Clearing House, a serious downtown institution made up of the city's biggest banks, wrote 3 numbers on a chalkboard. Those numbers came straight out of the day's financial trading totals. Within minutes, somebody had copied those same digits and phoned them uptown, where they meant something completely different, to a very different kind of business. That business was called the numbers game, sometimes policy. It worked simply enough that almost anybody could play. You picked 3 digits between 0 and 999. You handed your bet, sometimes for as little as a penny, to a neighborhood runner who worked the local barber shops, beauty parlors, and street corners. If the day's official number, the one pulled from those clearinghouse figures, matched your pick, you won big. Payouts often ran 600 to 1. Bet a dime, win $60, an enormous sum for somebody scraping by on a factory wage in 1925. It needs to be said plainly. This was illegal gambling. Police could arrest you for playing it, and people sometimes did get arrested, including the bankers who ran the operations. But here's the part that explains why it became so deeply woven into black community life for decades. At a time when white-owned banks across New York routinely refused black customers loans, refused them mortgages, and refused to take their savings seriously at all, the numbers game became, in the words of one historian who studied it closely, akin to putting money into the stock market for people who had no other version of investing available to them. The person running the whole operation was called the banker. The job title wasn't an accident. A numbers banker functioned a lot like an actual bank, just entirely outside the law. Bankers took in money from thousands of small bettors across the neighborhood, much the same way a real bank takes deposits from thousands of customers, and that pooled money funded loans, paid out winnings, and in many cases funded legitimate black-owned businesses that white banks had refused to finance at all. One of the most famous bankers in Harlem during this era was a woman named Stephanie St. Clair, known across the neighborhood as the Numbers Queen. By 1930, one newspaper estimated her personal fortune at around $500,000, worth close to $8 million today, and reported that she owned several apartment buildings. She had arrived in New York without access to the same banking and investment opportunities white New Yorkers took for granted, and she built her entire fortune inside this informal, illegal economy instead. By 1925, researchers later found that there were already 30 separate numbers banks operating in Harlem, some large enough to collect bets across 20 city blocks. The money moving through this system in New York alone eventually grew into the tens of millions of dollars per year. By the 1960s, one estimate placed the numbers game's economic footprint at roughly 60% of Harlem's total economic activity, run almost entirely by black operators serving a black customer base, completely separate from the downtown banks that had shut their doors to that same community. What did people actually do with their winnings? Historians who studied the era found that winners paid off bills, bought radios and clothes, sent money to relatives in the South, and in some cases used a big win to start their own small business, a grocery store, a bar, sometimes even their own numbers operation. One scholar described the typical hope this way: the person who hit big might open a business, pay off debt, or finally send a child to college. The same goals families pursued through savings clubs and church-building funds, just chasing them through a much riskier path. This black-run version of the numbers game didn't last forever, as a black-controlled industry though. By the early 1930s, white organized crime figures like Dutch Schultz noticed how profitable the racket had become and moved in by force, using violence and intimidation to push black bankers like Stephanie St. Clair out or force them to hand over a cut of their earnings. By the late 1930s, much of the profit that had once stayed inside Harlem was being funneled out to white-controlled crime organizations instead, and black involvement in running the game never fully recovered the same level of control it had held in its earliest years. So the numbers game stands as a complicated piece of this history. It was illegal, it carried real risk, and the odds, just like any lottery, were stacked heavily against the everyday person placing the bet. But it also reveals something important about how completely black communities were locked out of legitimate banking for generations, forced to build entire parallel financial systems just to have any access at all to savings, credit, and investment, even when that system existed in a gray space the law refused to recognize. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. There was nothing gray about layaway though. That system ran in plain daylight, inside the same department stores that often treated black customers worse than anybody else walking through the door, and it worked off a rule that flipped credit completely upside down. Lesson 13. Layaway. The opposite of owing department stores didn't trust everybody with credit. Plenty of black families, even when they had steady jobs and steady incomes, found themselves turned away when they tried to open a store charge account or finance something through a regular installment plan. So stores offered a different option, one that didn't require any credit check at all, and it became one of the most relied upon tools in working-class households for most of the 20th century. Layaway. Here's how it worked. And it worked the exact opposite of how credit works. With credit, you take the item home first and pay for it later. With layaway, you pay first, a little at a time, and the item only comes home once every single dollar has been handed over. You'd walk into a store, find the coat, the toy, or the piece of furniture you wanted, and put down a small deposit. The store wrote your name on it, tucked it away in a back room or a storage area, and held it there for you. Every week, or every payday, you came back and paid a little more toward the total. No interest got added. No credit check determined whether you qualified. The store simply held your item safely until the day your final payment cleared, and only then did it actually become yours to carry out the door. This wasn't a new invention born out of one single decade. Department stores were already running early versions of these payment plans as far back as the very start of the 20th century, with advertisements for layaway-style purchases on jewelry appearing as early as 1901 and on clothing by 1909. But the practice exploded into everyday use during the Great Depression in the 1930s, when unemployment climbed toward 25%, and millions of families across the country had almost no spare cash sitting around, and even less access to credit from banks already failing left and right. One department store advertisement from 1937 captured exactly why layaway made sense to so many families. It encouraged shoppers to pick out a winter coat in the off-season, put a small deposit down, and let the store hold onto it until the cold weather actually arrived and the coat was needed. By the time winter came, the coat was fully paid for, with nothing owed to anybody. That last part is the whole point. Nothing owed to anybody. For a family that had already learned hard lessons about what debt could do, whether through a sharecropping ledger that never seemed to balance in their favor, or a furnishing merchant store account that grew faster than any crop could pay it down, layaway offered something rare. A way to get exactly what you wanted, on your own schedule, without a single cent of interest stacking up against you while you waited. Compare that to a regular installment plan, or an early store credit account, where you'd take the item home immediately and then spend months, sometimes paying interest on top of the original price, the whole time you owed the balance. With layaway, the store carried all the risk instead of you. If you couldn't finish paying, the worst that usually happened was you lost your deposit and maybe a small fee, and the item simply went back on the shelf. You never ended up owing money for something you no longer even had in your possession. Layaway worked especially well around the holidays, and stores built entire seasonal programs around exactly that timing. A family could start putting money down on Christmas gifts as early as the late summer or early fall, spreading the full cost of the holiday across many small payments instead of facing one enormous bill in December that the household budget simply couldn't absorb in a single month. This turned what could have been a financially crushing season into something manageable, paid for gradually, dollar by dollar, week after week. Layaway eventually faded out of common use once credit cards became widely available in the 1950s and 1960s, since suddenly almost anybody could walk out of a store with an item in hand and worry about the bill later. But for families who had spent generations being denied that same easy access to credit, or who simply preferred never owing a balance they hadn't already paid off, layaway never really stopped making sense. It came roaring back during hard economic stretches like the Great Recession in the late 2000s, when credit dried up all over again and families went looking for the same patient, debt-free way to get what they needed that their grandparents had relied on decades earlier. That same patience, paying first and collecting later, instead of collecting first and paying later, showed up in one woman's business model too. Except she wasn't selling coats or furniture out of a department store. She was selling a hair product door to door, one customer at a time, and turning every single sale straight back into building something far bigger than the product itself. Lesson 14. Sell it door to door, then teach the next woman. She was born Sarah Breedlove in 1867 in Delta, Louisiana, the daughter of two people who had been enslaved. Her parents and older sister had been born into slavery. She was the first person in her family born free. By age 7, both her parents were dead, victims of a yellow fever outbreak, and she moved in with her sister, working as a domestic servant to survive. She spent years doing laundry for other people, the same back-breaking work her mother had once done. Sometime in the 1890s, she developed a scalp condition that caused severe hair loss, common at the time partly because most black households still lacked indoor plumbing, which made regular hair washing difficult. She wasn't alone in this struggle. Countless black women across the country dealt with the same problem, and had almost no products made specifically for their hair, so she built one herself. Around 1904, working in St. Louis, she became a commission sales agent selling hair products for a businesswoman named Annie Turnbow Malone, who ran a company called Poro. While working for Malone, Sarah began developing her own formula. The next year, in 1905, she moved to Denver, Colorado, and started selling that formula on her own, going door to door through black neighborhoods, demonstrating her product directly to the women who needed it. In 1906, she married Charles Joseph Walker and began calling herself Madame C.J. Walker, borrowing the title Madame from the French beauty industry to project an image of dignity and seriousness. Her product, called Madame C.J. Walker's Wonderful Hair Grower, treated scalp conditions and promoted healthier hair. She sold it the same way she'd started, door to door, and gave demonstrations in churches, where black women already gathered and already trusted each other. Here's what made her business different from almost anybody else's at the time. She didn't just want to sell a product. She wanted to build an army of saleswomen, each one earning real income, each one trained the exact same way, so the business could grow far beyond what one woman alone could ever sell door to door by herself. She called her sales force Walker Agents. These women learned what came to be called the Walker System, a specific method involving shampoo, a scalp treatment, careful brushing, and a heated comb, adapted specifically for black hair texture. Walker built actual schools to teach this system, opening one in Pittsburgh in 1908 and a much larger headquarters in Indianapolis in 1910, complete with a factory, a laboratory, a beauty school, and her own salon. By 1917, her company claimed to have trained nearly 20,000 women in the Walker system. Think about what that meant for the individual woman who became a Walker agent. One of Walker's own advertisements made the math plain. It told women that as a Walker agent, you could make more money in a single day selling these products than you could earn in an entire month working in somebody else's kitchen. For women whose only other realistic job options were washing other people's laundry or cleaning other people's homes, that wasn't exaggeration. It was a genuine path toward financial independence that almost no other industry was offering them. Walker also did something rarer still. She helped finance franchised beauty shops for these women, at a time when black Americans were routinely denied loans by commercial banks. A woman who wanted to open her own shop, selling Walker products and offering services like shampooing, styling, and hot oil treatments, could get backing through Walker's company instead of being turned away at a bank downtown. That single decision turned thousands of individual sales jobs into thousands of small black-owned businesses scattered across the country. By the time Walker died in 1919, her company had spread well beyond the United States, reaching customers in Cuba, Jamaica, Haiti, Panama, and Costa Rica. She had become known as the wealthiest black businesswoman and the wealthiest self-made woman in the entire country, all built from a formula she developed herself and a sales model that put money directly into the hands of thousands of other black women along the way, not just her own. Her wealth never stayed locked up in one place either. She gave substantial donations to organizations like the NOC, funded scholarships, and supported black artists and architects. In 1912, speaking before the National Negro Business League, she described her own path plainly. She said she came from the cotton fields of the South, got promoted to the washtub, then promoted to the cook's kitchen, and from there promoted herself into the business of manufacturing hair products. That's exactly what she had done. One door-to-door sale, one trained agent, one financed beauty shop at a time. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. This model, build something yourself, then immediately teach the next woman how to build it too, didn't only show up in hair care. It echoed in kitchens all across the country, every single payday, the moment a family's cash hit the table and got divided up into separate piles before a single dollar of it could disappear, somewhere it wasn't supposed to go. Lesson 15. Money got divided before it could disappear. Payday meant one thing above everything else. The money on the kitchen table had to be split up immediately. before it had a chance to slip away on something that wasn't planned for. This is the envelope system, and it ran on one simple rule. Decide where every dollar is going before you spend a single one of them. Here's exactly how it worked. As soon as the cash came in, whoever managed the household money divided it into separate piles, sometimes literal envelopes with a bill or category written across the front in pen. Rent, light bill, groceries, church, whatever was left over after the essentials got covered. Each envelope only held exactly what that category needed for the coming week or month. Nothing more. Once an envelope was empty, spending in that category stopped completely until the next payday refilled it. That single rule changed everything about how a family handled money. It wasn't about tracking what you had already spent after the fact. It was about deciding in advance exactly what your money was allowed to do, before temptation, an emergency, or somebody else's request had a chance to talk you out of the plan. This kind of cash-based budgeting started showing up in American households around the turn of the 20th century, well before the Great Depression made the practice spread even further. Back then, almost nobody had a credit card, a debit card, or a banking app to check a balance with. Cash was the only form of money most working families ever touched, which meant cash had to be managed the old-fashioned way, by hand, divided up the moment it landed in the house. For families that had been turned away from banks, denied credit, or simply never trusted the financial system enough to rely on it completely, this system did something a bank statement couldn't. It made the household budget physically visible. You didn't need to do math in your head to know whether you could afford something. You opened the envelope and looked. If it was empty, the answer was no. Plain and simple. No argument needed. This mattered enormously for households running on tight margins, where one wrong guess about how much was left for groceries could mean the difference between making it to the next payday and coming up short. Splitting the money into separate envelopes the moment it arrived removed the guesswork entirely. The grocery money stayed completely separate from the rent money, which stayed completely separate from whatever got set aside for church or for the children's clothes, so that one category running short never accidentally ate into money that had already been promised somewhere else. The discipline required real commitment, because the temptation to borrow from one envelope to cover a shortfall in another never fully disappeared. But the families who stuck with the system strictly treated each envelope as untouchable for anything except its own specific purpose. Light bill money paid the light bill. It didn't get borrowed for anything else, no matter how convincing the reason seemed in the moment, because borrowing from one envelope today almost always meant a real problem showing up in that same envelope later. This approach worked especially well alongside everything else already covered. The mason jar sitting on the shelf held long-term savings, untouched for months at a time. The envelopes handled the week-to-week and month-to-month flow, the rent, the bills, the groceries, the small contributions to the church building fund or the burial society dues. Different containers, different jobs, but the same underlying instinct running through all of them. Decide where the money goes the moment it arrives, and don't let it drift somewhere unplanned once it's already in your hand. Children growing up in these households learned the system simply by watching it happen, payday after payday, for their entire childhood. Nobody needed to sit a child down and explain percentages or budgeting theory. They watched their mother or grandmother count out the cash, fill the envelopes one at a time, and set aside whatever was left for anything unplanned. That repetition, watched closely enough times across enough years, became its own kind of education, one that never needed a textbook to make its lessons stick. And that lesson, decide in advance where your money goes, and never let it slip past you unaccounted for, fed directly into the single rule that tied every single one of these habits together. It wasn't really about pennies, jars, envelopes, or partner hands at all. It was about one sentence, repeated to children across generations, that summed up everything this entire way of handling money was built to protect. Lesson 16. Never owe anybody anything you can't pay back. Every single habit covered so far, the partner hand, the mason jar, the burial society, the church fund, the garden, the quilt, the paid-off house, the envelopes split at the kitchen table, All of it traced back to one sentence that got repeated in households across generations. Never owe anybody anything you can't pay back. Some families said it almost exactly that way. Others said it differently, but the meaning stayed the same no matter which words carried it. This wasn't abstract advice handed down in a lecture. It usually came out in small, specific moments. A child asking for something at the store that the family hadn't budgeted for. A teenager wanting to put a purchase on credit before credit was something the family fully understood or trusted. A young adult considering a loan they weren't completely sure they could repay on time. In each of those moments, somebody older in the family stepped in with the same basic message, repeated so many times it became part of how that child eventually thought about money for the rest of their life. Why did this lesson carry so much weight? Because so many of the financial systems built around Black families for generations were specifically designed to trap people in debt that never seemed to shrink. The sharecropping system after the Civil War kept families locked to a landowner's ledger, where the landlord set the price of the crop at settlement time and never had to put the agreement in writing or open the books to the very people who had worked the fields all year. Many sharecroppers ended every single harvest owing more than they had the year before, no matter how hard they worked, simply because the system was built that way on purpose. The furnishing merchant system worked the same way. A family without cash could buy seed, tools, and food on credit from the local merchant, but the interest charged on that credit often ran far higher than anything a bank would have charged, and the family had almost no power to question the bill. One bad harvest, one unexpected expense, and that debt could follow a family for years, sometimes locking them onto the same land under the same terms indefinitely, with almost no legal way out. So when families later managed to break free of these systems, through migration north, through buying their own land, through opening accounts at banks like Maggie Walker's St. Luke Penny Savings Bank, the lesson they carried forward wasn't subtle. Debt had nearly cost their families everything for generations. The way out wasn't to avoid every loan forever. The way out was to never take on more than you could see your way clear to paying back, on your own terms, without anybody else holding power over you because of it. This is exactly why paying cash for a car mattered so much in households that could manage it, even if it meant waiting years longer to actually buy one. A car bought outright belonged completely to the person who paid for it. A car financed through a loan could be repossessed the moment a payment got missed, no matter how many payments had already been made before that. The same logic applied to paying off a mortgage early, to avoiding store credit accounts when layaway was available instead, and to treating every dollar borrowed as a dollar that had to be accounted for and repaid, not a convenience to be worried about later. Parents and grandparents taught this lesson the same way they taught almost everything else in this list, by living it out loud in front of their children rather than explaining it in a formal sit-down conversation. A child who watched a grandmother refuse to buy something she couldn't pay for in full learned that lesson more deeply than any speech could have taught it. A child who watched a father celebrate the day the mortgage finally got paid off in full understood, without being told directly, exactly how much that moment meant and exactly why it had taken so many years of extra payments to get there. The lesson wasn't about avoiding all risk forever, and it definitely wasn't about refusing every form of borrowing on principle. Families still took out mortgages, still bought on layaway, still occasionally relied on credit when no other option existed. The real lesson was about control. Owe only what you can see a clear path to repaying, on a timeline you actually control, to people or institutions who can't simply take everything from you the moment one payment runs late. That single instinct, protect your own independence above almost everything else, is the thread running underneath every single lesson already covered. The partner hand worked because everybody paid in and trusted each other to pay back fairly. The burial society worked because dues got paid faithfully, so nobody's family went without when death came calling. The garden, the quilt, the mortgage paid off early. The envelope that ran empty and stayed empty until the next payday. None of it was really about scarcity or deprivation. It was about making sure nobody outside the family ever held enough power over that family's survival to take it all away on a whim. Before we move on, If you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. There's still more of this story to tell, because not every lesson passed down was about saving or avoiding debt at all. Some of it was about building a business strong enough to employ an entire neighborhood, the way a single beauty shop chair once became the meeting place where money, gossip, and opportunity all changed hands at the exact same time. Lesson 17. The barber's chair built a bank. John Merrick was born into slavery in Clinton, North Carolina, in 1859, the son of an enslaved mother. After emancipation, he moved with his mother to Chapel Hill, where she worked as a domestic servant while he labored in a brickyard, learning to read and write at a school built during Reconstruction. By his teenage years, he was working construction as a brick mason in Raleigh, but the work was unsteady, so he picked up a second skill during slow stretches: barbering. That second skill ended up changing everything. Merrick worked his way up from shining shoes in a Raleigh barbershop to cutting hair himself, eventually earning a partnership in the business. In 1880, the shop relocated to Durham, North Carolina, and by 1892, Merrick owned it outright. He kept expanding from there, eventually owning 5 barbershops across Durham, 3 serving white customers and 2 serving black customers, all staffed entirely by black barbers. Here's why that detail matters so much. The barbershops serving white clientele put Merrick in direct, regular contact with some of Durham's most powerful and wealthiest men, including members of the Duke family, the tobacco fortune that shaped much of the city. Those men sat in Merrick's chair regularly, and over years of conversation, Merrick built real relationships with people who controlled serious money and serious influence in Durham, relationships that very few black men in the post-slavery South ever had the chance to build. Merrick used those relationships and the profits from his barbershops to start moving into other ventures. He invested in real estate, building housing for black workers pouring into Durham to work in the city's growing tobacco industry. But his most consequential move came through something he learned almost by accident. In 1883, Merrick and a group of partners purchased a fraternal organization called the Royal Knights of King David, the same kind of mutual aid and burial society that families across the South relied on to cover funeral costs and illness. Serving as the group's treasurer, Merrick learned the entire mechanics of how insurance actually worked, how dues got collected, how claims got paid, and how a small weekly contribution from thousands of people could add up to something large enough to protect an entire community. In 1898, Merrick took that knowledge and went much further. Along with several other Durham business and professional leaders, including Dr. Aaron McDuffie Moore, he founded the North Carolina Mutual and Provident Association, a real insurance company built specifically to serve black families who white insurance companies refused to cover at all. The business opened its doors on April 1, 1899. Its first month of collections after paying commissions came to just $1.12. From that almost nothing starting point, the company grew into what eventually became the largest black-owned business in the entire United States, later renamed North Carolina Mutual Life Insurance Company. The company specialized in what was called industrial insurance, essentially the same kind of burial coverage that fraternal societies had offered for decades, except now run as a proper, regulated business. Agents collected small weekly payments, often around 10 cents, from policyholders across the community. If someone died while covered, the company paid out roughly $100 almost immediately, enough to cover a respectable funeral, which carried enormous importance and pride within black communities of that era. Merrick didn't stop with insurance either. He went on to help found Mechanics and Farmers Bank in Durham, giving black residents access to real banking services at a time when white banks across the South routinely refused to lend to black customers at all. He helped start the Merrick Moore Spalding Real Estate Company to offer property insurance the insurance regulations wouldn't let his main company provide. He helped open the Bull City Drug Company, giving black pharmacists a place to actually practice the trade they had trained for, since white-owned drugstores wouldn't hire them. He even used his relationship with the Duke family to secure funding for Lincoln Hospital, Durham's first hospital built specifically to serve black patients. All of these businesses eventually clustered together on a single street in Durham called Parish Street, a strip that came to be known as Black Wall Street, one of several such districts that sprang up in cities across the country during this era. North Carolina Mutual rented out space along that same street to other black-owned businesses, multiplying the opportunity that had started with one man cutting hair decades earlier. Every single piece of this empire, the insurance company, the bank, the real estate firm, the drugstore, the hospital funding, traced its roots back to a barber's chair, where a man born enslaved built relationships, learned a trade, and listened carefully enough to understand exactly what his own community needed, that nobody else was willing to provide. That same chair, in barber shops and beauty shops all across the country for generations afterward, kept doing quiet work far beyond just cutting hair. Money got loaned between regulars who trusted each other. Job leads got passed from one customer to the next. And sometimes, the most important conversation happening in the whole neighborhood that week was the one taking place between a stylist and a client who had nowhere else they felt safe enough to say what was actually on their mind. Lesson 18: The Rent Party. If you lived in Harlem in the 1920s, every so often you'd find a small printed card tucked into your mailbox, slipped under your door, or handed to you at the barbershop. No envelope, no fancy invitation, just an address and a date for a Saturday night. Nobody needed to RSVP. If you got the card, the person who left it knew you'd show up. That card was an invitation to a rent party, and the name said exactly what it was for. Harlem's housing situation in the 1920s and 1930s was brutal by design. Black tenants routinely paid far more for far less space than white tenants paid elsewhere in the city. In 1920, a one-room apartment in Harlem might rent for $40 to a white tenant, but landlords charged black tenants somewhere between $100 and $125 for that exact same room. By the late 1920s, working-class white families across the city paid around $6.67 per room each month, while black families in Harlem paid $9.50 for the same kind of space. The worse the apartment, the more desperate the renter, the higher landlords pushed the price, almost as if the desperation itself was the thing being charged for. At the same time, most black workers earned less than white workers doing comparable jobs, so the math simply didn't work. Rent came due on the first of every month, no matter how thin a paycheck had stretched to cover everything else, and falling behind meant eviction, plain and simple. Families needed a way to close that gap fast, and they needed it every single month, not just once in an emergency. The rent party filled that gap. Here's exactly how it worked. A tenant who needed help making rent would clear the furniture out of their front room, push the rugs back, and set up chairs along the walls. They'd hire a piano player, sometimes the only musician they could afford, and the music had to fill the whole room by itself, since there usually wasn't money for a full band. Guests paid a small entrance fee at the door, often around 25 cents, just to get in and dance. Food cost extra. Pork chops, stewed cabbage, black-eyed peas and rice, potato salad, the same kind of cooking many newly arrived Southern migrants missed most after moving north. Every quarter that came through the door, every plate sold at the kitchen table, went straight toward whatever was owed to the landlord. This wasn't a brand new idea invented in Harlem. The custom traveled north with the Great Migration itself. In the South, neighbors had long gathered to help a friend or relative through a sudden financial setback, an unexpected medical bill, or any hardship that threatened to knock a family off balance. Harlem just adapted that same instinct to fit the specific crisis northern cities created: sky-high, racially inflated rent that came due whether a family could afford it or not. Word spread through the neighborhood in the most ordinary ways possible. Tickets got tucked into elevator grills, slipped into apartment window frames, or handed out at a corner bodega or a barbershop chair. The same barbershop chairs that, in other corners of black communities, had already become places where information, opportunity, and trust changed hands constantly. Hosts sometimes targeted specific groups, likely to have cash on a given night, like Pullman porters just back from a long train run, or out-of-town visitors looking for a good time. Competition between hosts got fierce too. On a single block in Harlem during the busiest years, as many as 12 different rent parties might be running at the same time, sometimes 5 happening inside one single apartment building on the same night. Black women very often ran these events, since household financial management already fell largely on their shoulders, and a successful rent party meant real money, real independence, and real standing in the neighborhood for the woman who pulled it off well. Hosting wasn't just a desperate last resort. For many women, it became its own small business, run out of their own front room, month after month, as steady and necessary as any other source of household income. The musical side of the rent party turned into something nobody fully expected either. Because hosts could only afford one pianist most nights, that single musician had to fill an entire room with sound, using just 2 hands, playing the rhythm with the left hand, while the right hand carried the melody and improvisation. This pressure helped birth an entire style of piano playing called Harlem Stride, made famous by musicians like James P. Johnson, Fats Waller, and Willie the Lion Smith, men who first sharpened their skills competing inside these same crowded front rooms before any of them ever played a proper concert stage. The rent party held real risk too. Crowded apartments, loud music late into the night, and homemade liquor sold under the table during Prohibition occasionally drew complaints from neighbors or visits from the police. Most of those situations got smoothed over simply by inviting the officer in to enjoy the party along with everybody else, since the whole point was keeping a roof over a family's head, not breaking any law worth enforcing strictly. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. By the time the Great Depression hit in the 1930s, rent parties had become an even more essential survival tool, since paid entertainment elsewhere had dried up almost completely, and even fewer families could spare any extra money at all. The instinct underneath it all never changed though. When the system charges you more than you can afford and gives you no other path forward, you don't wait around for the system to fix itself. You open your front door, you cook the food yourself, you find one piano player willing to carry the whole night on 2 hands, and you turn your neighbor's quarters into next month's rent, one Saturday night at a time. Lesson 19. The Christmas Club Check-In. 1909, a bank treasurer named Merkel Landis, working at the Carlyle Trust Company in Pennsylvania, came up with a simple idea. Let people save for Christmas all year long, in small weekly amounts, instead of scrambling to cover the holiday all at once in December. He called it a Christmas Savings Fund. About 350 customers signed up that first year, saving an average of $28 each, money that worked out to roughly $1,000 in today's terms. The idea spread fast, because it solved a problem nearly every working family understood. Christmas came with real costs attached: gifts, food, maybe new clothes for the children, and that bill arrived all at once in December, no matter how thin a family's budget had stretched through the rest of the year. Before credit cards existed, there was no way to spread that cost out after the fact. The Christmas Club flipped the timing, spread the cost out before the holiday hit, in small pieces nobody would miss week to week, so the money was already sitting there, fully saved, by the time the holiday actually arrived. Here's exactly how it worked. A family opened a Christmas Club account at their local bank, sometimes with just a few dollars to start. Every week, or every payday, they brought in another small deposit, maybe $1, maybe $5, whatever the family could manage. The bank locked that money away, and the account holder couldn't simply walk in and pull money out whenever they felt like it. Most banks charged a penalty for early withdrawal, on purpose. The whole design of the account assumed that if the money was too easy to reach, somebody would eventually dip into it for something else, and the Christmas fund would come up short right when it mattered most. Then, right before the holiday season, usually sometime in November, the bank closed out the account and handed the saver a check for the full amount, ready to spend on gifts. Some banks even gave out small souvenir tokens when somebody opened an account, little keepsakes good for a quarter toward the first deposit, treating the start of a Christmas club almost like its own small occasion worth celebrating. This system mattered enormously for working-class families who had no other reliable way to force themselves to save. A columnist writing about Christmas clubs back in 1928 put it about as honestly as anybody could. She said there was no romance in saving money just to have money sitting in a bank account. But people would absolutely save, and save consistently, for something they believed would bring them real happiness. Something tangible they could picture clearly, like a child's face on Christmas morning. The bank wasn't really protecting the money from outside thieves. It was protecting the money from the account holder's own future temptation to spend it on something else before December ever arrived. Christmas clubs became especially popular during the Great Depression of the 1930s, exactly the moment when families needed every possible tool to avoid going into debt over the holidays. With jobs scarce and money tighter than ever, a small, steady, locked-away savings habit meant the difference between walking into December with cash already set aside, or walking in with nothing and turning to debt just to give children a normal Christmas. This tool fit naturally alongside everything families were already doing to manage tight household budgets without relying on credit. The same instinct that filled an envelope for rent, dropped coins into a mason jar for emergencies, or paid weekly dues into a burial society, applied just as easily to Christmas. Decide in advance what you're saving for. Commit to a small regular amount, and let time and discipline do the rest of the work, instead of scrambling at the last minute and reaching for debt to cover the gap. For families who had already learned hard lessons about what debt could cost, watching a sharecropping ledger never balance in their favor, or watching a furnishing merchant's account grow faster than any harvest could shrink it, the appeal of a Christmas club went beyond simple convenience. It offered a debt-free holiday, paid for entirely in advance, with nothing owed to anybody, once December actually arrived. The gifts under the tree had already been earned and paid for months before they were ever wrapped. Banks loved offering these accounts too, for their own reasons. They got to hold on to customers' money all year, often paying little or no interest on it, while building loyalty and bringing people into the bank regularly enough that many depositors eventually opened other accounts as well. Local department stores caught on to the pattern and started accepting Christmas club checks directly as payment, making it even easier for a family to walk straight from the bank to the store and spend their saved money on exactly what they had been planning all year to buy. Christmas clubs eventually faded through the 1970s and 1980s, as credit cards became common enough that most Americans simply charged their holiday spending and paid it off afterward, instead of saving ahead of time. But the habit of saving small and steady all year for one specific December expense never fully disappeared in households that valued staying out of debt above almost everything else. The exact account name changed, and eventually most families managed the same idea quietly through their own envelope or their own savings jar, instead of a bank's official Christmas club. But the underlying discipline, plan ahead, save small, and never let the holidays push you into debt, carried straight through, the same way almost every other money lesson in this list eventually did. Lesson 20. A dollar that stayed home. In Tulsa, Oklahoma, in the years before 1921, there was a 35-block neighborhood called Greenwood. Black families there built something so complete, so self-sufficient, that newspapers and visitors of the era started calling it Black Wall Street. Inside Greenwood sat grocery stores, restaurants, movie theaters, hotels, law offices, doctors' offices, 2 newspapers, a hospital, a public library, and a school system, all owned and run by black residents, serving black customers, in a city where segregation kept black residents largely shut out of white-owned businesses anyway. That last part matters more than it might seem at first. Jim Crow segregation forced black Tulsans to spend their money inside their own neighborhood, since white businesses across town often wouldn't serve them at all. Instead of treating that restriction as pure punishment, Greenwood's residents turned it into something else. A dollar earned inside the neighborhood tended to stay inside the neighborhood, passing from the grocer to the barber to the landlord to the seamstress, circulating again and again before it ever left for good. Economists have a name for this idea: the velocity of money. How many times a single dollar changes hands within a community before it exits? Greenwood, by simple necessity, built a community where that velocity ran high. This wasn't an accident of geography either. It took real entrepreneurs willing to build something from nothing. One of Greenwood's most successful businessmen, O.W. Gurley, arrived in Tulsa in 1906 and purchased 40 acres of land, specifically intending to develop it for black residents and black-owned businesses. He opened a rooming house, and from that single building, an entire commercial district grew up around him. Another resident, J.B. Stratford, built the Stratford Hotel, at the time considered one of the largest black-owned hotels in the entire country, complete with a saloon, a gambling hall, and dozens of rooms, all serving a black clientele that white-owned hotels across Tulsa wouldn't admit. The wealth being built inside Greenwood was real and substantial, not symbolic. Some residents owned multiple properties. Doctors and lawyers practiced inside the neighborhood, serving patients and clients who couldn't access white professionals elsewhere in the city. Children attended well-regarded schools. Families who had arrived in Oklahoma with almost nothing built homes, businesses, and a level of financial stability that few black communities anywhere else in the country had managed to achieve at that point in American history. Then, over 2 days in late May and early June of 1921, it was destroyed. A white mob, fueled by a false accusation against a young black man named Dick Rowland, attacked Greenwood directly, burning homes and businesses to the ground, looting what they didn't burn, and in many documented accounts, firing on residents as they tried to flee or defend their property. Estimates of the dead vary, with historical investigations suggesting the toll likely ran into the hundreds, though an exact count has never been firmly established because of how the violence and its aftermath were handled at the time. More than 1,000 homes were destroyed. Thousands of residents were left homeless almost overnight. What happened afterward reveals just as much as the destruction itself. Insurance companies largely refused to pay out claims for the damage, citing riot exclusion clauses common in policies of that era. City officials, rather than helping rebuild, in some cases passed zoning ordinances explicitly designed to make rebuilding harder for black property owners. Many Greenwood families who had spent years and sometimes decades building businesses and accumulating property were left with nothing, not because they had made any financial mistake, but because an entire community's wealth got erased in roughly 16 hours, and the systems meant to help them recover simply didn't. This story matters inside a list of money lessons, for an uncomfortable reason. Every habit covered so far, the partner hand, the burial society, the church building fund, the paid-off mortgage, the quilt made from scraps, assumes that if a family does everything right, builds carefully, saves patiently, and avoids unnecessary debt, that wealth will eventually compound and pass safely down to the next generation. Greenwood proves that assumption wasn't always enough. Sometimes the wealth itself, no matter how carefully and honestly it was built, could be taken by force, with almost no path to recovery offered by the very institutions, insurance, government, banking, that were supposed to protect property owners equally. Despite all of that, some Greenwood residents did rebuild, brick by brick, in the years that followed, refusing to simply walk away from land and businesses they had built with their own hands. It never fully returned to what it had been before 1921. But the fact that anyone rebuilt at all says something about the same stubborn instinct running through every other lesson in this list. Even after everything was taken, the response wasn't to give up on ownership entirely. It was to start again, the same way families had started again after losing land during Reconstruction, after losing savings when the Freedmen's Bank collapsed, after every other moment in this long history when the ground shifted out from under them without warning. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That same refusal to give up on building something permanent, no matter how many times the rules got rewritten against them, is really the thread running through every single lesson in this list. From the partner hand passed quietly between neighbors, all the way to a 35-block neighborhood that, for a short while, proved exactly what was possible when a community kept its dollars circulating among its own. Lesson 21. Nothing got worn once. When a pair of pants got too tight or too short for one child, those pants didn't get thrown away. They went straight onto the next child in line, patched at the knee if needed, hemmed if needed, worn until there was truly nothing left to wear. Clothing in these households didn't belong to one child. It belonged to the family, moving from body to body as each child grew, until the fabric itself finally gave out completely. This pattern showed up everywhere in working-class American households during the early and mid-20th century, and it showed up just as strongly inside black sharecropping families across the South. One woman who grew up sharecropping in Rex, North Carolina, remembered the rule plainly from her own childhood. Her family got one pair of shoes a year, sometimes two, bought deliberately, one size too big, so a child wouldn't outgrow them before the season ended. One pair for school, every day, one pair saved for church. Everything else her family wore, she said, was homemade. That homemade clothing very often started its life as something else entirely. When the white-owned plantation or farm bought feed for the hogs and chickens, that feed came packaged in plain white cloth sacks. Once the feed was used up, those sacks didn't get thrown in the trash. The landowner gave them straight to the sharecropping families, who washed the sacks clean and turned the cloth into underskirts and other basic clothing their children wore for an entire winter. This wasn't unique to one family or one farm. Across rural America, flour and feed manufacturers eventually figured out exactly what families were doing with their empty sacks. And by the 1920s and 1930s, companies started deliberately printing patterns onto the fabric, things like checks, florals, and plaid, specifically so women would choose one brand of flour or feed over another based purely on which sack made the prettiest dress. One feed store owner complained about this shift directly, saying farm wives had started asking him whether he carried egg mash in a flowered percale pattern, instead of asking for any particular brand of feed at all. The decision about which product to buy had quietly shifted from the man working the field to the woman doing the sewing at home. During the height of the Great Depression, this practice became so widespread that researchers later estimated around 3 million women and children across the country were wearing feed sack clothing at any given moment. By 1951, a government survey found that 97% of rural mothers had heard of making clothes from these sacks, and most had done it themselves at some point. A single dress for a young girl might only require 1 or 2 sacks, which made it especially practical for children's clothing, since kids outgrew their clothes constantly and needed something new sewn almost every season. There was a real tension built into this practice too, one that doesn't get talked about as much. Wearing feed sack clothing carried a quiet sting of shame for some families, since everyone in a small community generally knew exactly what it meant when a child's dress had that particular texture or weight to it. Some mothers worked hard to disguise where the fabric had come from, soaking off printed logos with kerosene or lard overnight, dyeing the cloth a different color, or adding decorative trim and buttons to make a feed sack dress look as close as possible to something bought new in a store. The clothing solved a real financial problem, but it also meant living with the small, constant awareness that everyone around you could likely tell exactly how tight your family's money really was. None of that stopped families from doing it anyway, because the alternative, buying new clothing for every growing child in the family, simply wasn't realistic on the wages most working-class families earned, black or white, sharecropping or otherwise. The math was unforgiving. A growing child needed new clothes every single year, whether the money existed or not, and feed sacks, already paid for as part of buying animal feed, were essentially free fabric sitting right there in the barn, waiting to become something useful instead of going to waste. Hand-me-downs worked the same basic math from a different angle. Instead of turning a feed sack into brand new fabric, hand-me-downs simply extended the working life of clothing that already existed. An older sibling's outgrown pants got patched and passed to a younger sibling. A dress worn thin at the seams got taken apart and re-sewn into something smaller for the next child in line. By the time clothing had truly worn past the point of being wearable at all, even then it didn't disappear. It got cut into pieces and stitched into a quilt, the same way old work clothes and worn dresses became quilt material, in places like Gee's Bend, giving the fabric one final job to do before it was finally retired for good. This entire cycle, sack to dress, dress to hand-me-down to quilt scrap, meant that almost nothing entering a household as cloth ever truly left it as waste. Every single piece of fabric got squeezed for every bit of use it had left in it, passed from purpose to purpose and child to child, until there was genuinely nothing more it could be turned into. Children who grew up inside this cycle absorbed something beyond just frugality. They learned, simply by living it every single day, that value didn't disappear the moment something wore out or stopped fitting. It just meant the object's next job hadn't been figured out yet. That same instinct, find the next use before throwing anything away, sat right alongside every other lesson on this list. The saved penny, the paid-off mortgage, the dollar that stayed inside Greenwood's 35 blocks, all built on the same underlying belief that nothing should slip away unused or unaccounted for. Not a dollar, not a debt, and not even a worn-out feed sack still good for one more season of wear. Lesson 22. Cash for the car, no exceptions. A car bought with cash belonged completely to the person who paid for it the moment they drove it off the lot. A car bought on a loan belonged, at least partly, to whoever held that loan, for as long as a single payment remained outstanding. That distinction explains why so many families treated saving up to buy a car outright, even if it took years longer than financing would have, as something worth the wait. The reasoning wasn't abstract or old-fashioned thinking, passed down without a real cause behind it. Black car buyers have faced documented, measurable discrimination in auto financing for decades, and research shows this pattern has continued well into the present day. A federal investigation by the National Fair Housing Alliance sent matched pairs of testers, one white, one non-white, into car dealerships in Virginia to ask about financing the exact same vehicle. The non-white tester in each pair was deliberately more financially qualified than their white counterpart, meaning a stronger credit profile and a stronger ability to repay the loan. Despite that, the testers of color received worse financing offers 62.5% of the time. White testers were offered more financing options to choose from 75% of the time. Over the full life of a loan, this discrimination cost the more qualified non-white buyer an average of $2,662.56 more than the less qualified white buyer paid for the identical car. This kind of markup has a specific mechanism behind it, and understanding that mechanism explains exactly why a car loan carries more hidden risk for a black buyer than it might appear to on the surface. Most car loans in America are what's called indirect loans, meaning the dealership arranges financing through an outside bank or lender rather than handling the loan directly themselves. Once that outside lender quotes the dealership an interest rate, the dealer is typically allowed to mark that rate up before presenting it to the customer, pocketing the difference as extra profit. Because the dealer has wide discretion over how much to mark the rate up, and because that markup usually isn't disclosed to the buyer at all, this system has repeatedly produced exactly the kind of racial disparity researchers have documented again and again. One of the largest cases of this kind came to light when federal regulators investigated Ally Bank, one of the country's biggest auto lenders. Investigators found that Ally had charged more than 235,000 minority borrowers higher interest rates on their auto loans between 2011 and 2013 alone. The bank was ordered to pay $80 million in damages to the Black, Hispanic, Asian, and Pacific Islander borrowers it had overcharged, plus an additional $18 million in penalties, making it, at the time, the largest auto loan discrimination settlement in American history. A separate analysis from the National Consumer Law Center found that black consumers were typically charged between $300 and $500 more in interest rate markups compared to white consumers buying comparable vehicles. Researchers studying this pattern have also worked to rule out other possible explanations, like differences in negotiating skill or default risk that might otherwise account for the gap. One detailed study using credit bureau records found that Black and Hispanic loan applicants were approved at rates 1.5 percentage points lower than white applicants, even after controlling for creditworthiness, while paying interest rates roughly 70 basis points higher on the loans they did receive. The same research found that these borrowers actually defaulted less often than their approval rates would suggest they should, evidence pointing toward racial bias in how the loans were being priced, rather than any real difference in repayment risk. This is the exact kind of risk a family avoided completely by saving up and paying cash outright. A car bought without a loan meant there was no dealer markup to negotiate, no interest rate that could be quietly inflated without the buyer realizing it, and no monthly payment that, if missed even once, could result in the car being repossessed, regardless of how many payments had already been made. The family that waited longer to buy that same car in cash walked away from the entire system that had been shown, repeatedly, to treat black buyers differently than white buyers, for the exact same vehicle and the exact same financial qualifications. This approach required real patience. Saving the full price of a car, rather than financing a portion of it, often meant driving an older vehicle for years longer than a loan would have allowed, or going without a car entirely while the savings slowly built up in whatever account or envelope was designated for that purpose. But it removed an entire category of financial risk from the equation, the same way paying off a mortgage early removed the risk of foreclosure, and the same way layaway removed the risk of accumulating interest on a purchase a family couldn't yet fully afford. The instinct underneath this habit matches every other lesson already covered. Systems built around lending, whether for a car, a house, or a sharecropper's seed and tools, had a long, well-documented history of pricing black borrowers differently than white borrowers for the exact same product. Paying in full, in cash, whenever a family could manage it, wasn't about distrust without reason. It was a direct, practical response to a pattern that researchers, federal regulators, and class action lawsuits have confirmed again and again, decade after decade, right up through settlements reached in the years just before this very recording. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That same wariness towards systems designed to extract more money from black families than from anyone else paying the exact same price for the exact same thing runs through nearly every habit on this list. And it leads directly to the final lesson, the one underneath every other lesson already covered, the simple instruction parents and grandparents repeated to children for generations, distilled down to its rawest and most essential form. Lesson 23. One sentence that held everything together. Every single thing covered up to this point. The partner hand passed quietly between neighbors. The tin hidden on the kitchen shelf. The burial society dues collected after church. The church building fund filled 1 quarter at a time. The bank built on pennies and 31-cent deposits. The land fought for and so often lost. The garden and the hog that fed a family through winter. The quilt stitched from a father's worn-out work pants. The mortgage paid off years ahead of schedule. The dinner shared across an entire extended family. The money sent south from a factory job up north. The numbers bet placed for a penny. The coat held safely on layaway. The door-to-door sale that became a beauty school. The envelope that ran empty and stayed empty. The barbershop chair that built a bank. The rent party that kept a roof overhead. The Christmas fund that arrived right on schedule. The scrap of fabric that became a child's dress. The cash saved up slowly so a car loan never had to be signed, and the 35 blocks of Greenwood that proved what a community could build when its dollars stayed home. All of it traces back to one sentence. Never owe anybody anything you can't pay back. That sentence sounds simple enough to dismiss at first. Plenty of families across plenty of cultures have said some version of it for generations. But for black families specifically, this sentence carried a weight that came from somewhere very specific. Somewhere documented clearly enough in the historical record that it isn't a matter of guesswork or feeling. It came from watching, generation after generation, exactly what happened to people who owed money to a system built to make sure they could never fully pay it back. Look at how many of these lessons trace directly back to that exact danger. The sharecropping system that emerged right after the Civil War kept families locked to a landowner's ledger, where the landowner alone set the price of the crop at settlement time and had no legal obligation to write the agreement down or open his books to the people who had worked the fields all season. The furnishing merchant extended credit at interest rates far higher than any bank would have charged, and one bad harvest could trap a family on that same land under those same unfair terms for years, sometimes for the rest of a person's working life. The Freedmen's Savings Bank, set up by the federal government itself right after emancipation, collapsed in 1874 due to mismanagement by its own white trustees, wiping out the life savings of tens of thousands of black depositors who had trusted it specifically because the government stood behind it. The Federal Housing Administration spent decades ensuring mortgages almost exclusively for white families, while drawing literal red lines around black neighborhoods and calling the presence of black residents a credit risk in its own official paperwork. Auto lenders, documented as recently as the years just before this very list was written, charged black car buyers measurably higher interest rates than white buyers, with the exact same qualifications, for the exact same vehicle. Every single one of those systems shared the same underlying design, whether anyone running them admitted it openly or not. Make it easy to fall into debt. Make it hard, sometimes nearly impossible, to climb back out. And once a family understood that pattern, really understood it, after living through it themselves or hearing about it directly from a parent or grandparent who had, the response wasn't to avoid every form of financial risk forever. The response was something more precise and more disciplined than simple fear. Control exactly what you owe, to whom, and on what terms, so that nobody outside your own family ever holds enough power over your survival to take everything away from you on a whim. That's the real engine running underneath every single lesson in this list. The partner hand worked specifically because no interest ever got charged and no outside bank ever got involved. Just neighbors trusting each other to pay in and pay out fairly, turn by turn. The burial society worked because small, manageable weekly dues protected a family from the single largest unplanned expense almost any household will ever face: a death in the family, without anyone needing to borrow against an uncertain future to cover it. Maggie Walker's bank accepted a deposit of 31 cents on its very first day, specifically because she understood that an institution built to serve people with almost nothing had to meet them exactly where they stood, not demand they already look wealthy before being taken seriously. The instinct to pay off a mortgage years ahead of schedule, to buy a car outright instead of financing it, to put a winter coat on layaway instead of a store credit account, all of it comes from the exact same place. Decide what you can actually afford to lose, and never let it be more than that. This sentence didn't usually get delivered as a formal lecture sat down for a specific occasion. It came out in small, ordinary moments, stretched across an entire childhood. A child asking for something at the store the family hadn't budgeted for that week. A teenager curious about credit before they'd ever fully understood what it cost. A young adult weighing whether to take out a loan they weren't completely sure they could repay on their own terms and their own timeline. In each of those moments, an older relative stepped in with some version of the same message, repeated so many times, across so many years, that it eventually became part of how that child thought about every single dollar that ever passed through their hands for the rest of their life. And the lesson worked precisely because it had been demonstrated, not just spoken. A child who watched a grandmother walk past something she wanted in a store window, simply because she hadn't yet saved the full price, learned that lesson far more deeply than any speech alone could have taught it. A child who watched a father celebrate the single day his mortgage finally cleared, fully paid, owned outright, with no bank holding any claim on it anymore, understood, without needing a single word of explanation, exactly how much that moment meant, and exactly how many years of extra payments it had taken to arrive there. A child who grew up watching cash get divided into envelopes the very moment it hit the kitchen table, before a single dollar had the chance to disappear somewhere unplanned, absorbed that discipline the same way they absorbed how to set a table or how to fold a fitted sheet. Nobody needed to explain the theory behind it. The repetition itself became the entire education. None of this ever meant refusing every form of borrowing on principle, and it definitely didn't mean treating every loan as something shameful or forbidden. Families still took out mortgages when buying outright in cash simply wasn't realistic. They still relied on layaway, on credit when no honest alternative existed, on whatever financial tool actually served their family's needs in a given moment. The real lesson was never about avoiding debt entirely, as some kind of religious commandment. It was about control, plain and specific. Owe only what you can clearly see a path to repaying, on a schedule you actually control, to people or institutions who cannot simply take everything you've built the instant one single payment runs late. That distinction matters enormously, because it's the difference between fear and wisdom. Fear says never borrow anything from anyone, no matter the circumstances. Wisdom says borrow only what you understand completely, only what you can see your way clear to repaying, and only on terms where the lender can't quietly take more from you than you ever agreed to owe. Every single grandparent who repeated some version of this sentence wasn't teaching fear. They were teaching the hardest-earned kind of financial literacy there is, the kind learned not from a textbook or a classroom, but from watching exactly what happened, again and again, across multiple generations, to people who trusted systems that were never actually built with their survival in mind. This is also why so many of these lessons involved building something separate entirely, a bank of your own making pennies into dollars, a savings club running on trust instead of a bank vault, a burial society funded by dimes instead of a corporate insurance policy, a beauty empire built door to door instead of waiting for a loan that would never come. When the existing systems wouldn't serve a family fairly, the answer wasn't simply to suffer through unfair treatment forever. The answer was to build a parallel version that did the same essential job, on terms a family could actually trust, even if that meant starting with almost nothing and growing it 1 penny, 1 dime, 1 quarter at a time. There's a reason this entire list traces back through hardship without ever once landing on despair. Every single lesson here describes people who had every reason to give up on the idea of building anything permanent at all, who watched land taken back after it had already been granted, who watched a federally backed bank collapse and erase their life savings, who watched an entire 35-block neighborhood burn to the ground in under a day, and who, in every single case, started again anyway. Not because starting again was easy, because the alternative, accepting that nothing they built would ever be allowed to last, was something none of them were willing to accept. That refusal, repeated across generation after generation, in mason jars and church envelopes and burial society dues and pennies, turned into dollars, is the actual inheritance being described in this entire list. Not the specific dollar amounts, which were often small. Not the specific tools, which have mostly changed or disappeared with time. The inheritance is the sentence itself, and the discipline behind it, passed down quietly, demonstrated more often than explained, from one generation to the next. Never owe anybody anything you can't pay back. Build what the world won't hand you, and when it gets taken anyway, start again. Lesson 24. The identity close. There is a particular kind of math that runs underneath every single lesson in this list, and it isn't really about money at all. It's about what a person does when the rules keep changing on them, when the ground keeps shifting just as they finally find solid footing, and when every system built to help them seems to have a hidden clause written in somewhere that excludes them anyway. Think about what it actually took to live this way, year after year, generation after generation. A formerly enslaved woman who joined a fraternal order at 14 years old and grew it into a bank that turned pennies into dollars. A family that watched the government promise them 40 acres, then take it back within months, and kept buying land anyway, piece by piece, on their own terms, for the rest of the century. A mother who stood over a hot stove in August, canning beans and figs, long after her hands had already worked a full day in the fields, because winter was coming whether she rested or not. A man who built 5 barbershops and turned what he learned cutting hair into an insurance company, a bank, and a hospital, because nobody else was going to build those things for his community. A neighborhood that rebuilt itself, brick by brick, after watching everything it had constructed burn to the ground in less than a day. None of these people had the luxury of believing the system would eventually correct itself on their behalf. They built around it instead, quietly, patiently, without waiting for permission, and without waiting for an apology that, in most cases, never arrived. That is not a small thing to have done. That is, in fact, one of the most demanding forms of discipline a human being can practice, sustained not for a single difficult year, but across an entire lifetime, and then handed down to the next person who would have to do it all over again under slightly different rules. There is a temptation, looking back at this kind of history, to feel only sadness for what it cost. And there is real cost here, undeniable cost. Land taken, savings wiped out, a bank account that should have existed but never got the chance to open, a mortgage that should have been approved on the same terms as anyone else's and wasn't. That cost is real, and naming it honestly matters more than smoothing it over with a softer story. But sadness alone misses something just as true sitting right alongside the cost. Every single person in this list also built something, not despite the hardship exactly, because that framing makes the hardship sound like background noise instead of the actual obstacle it was. They built through it, directly through the middle of it, using whatever tools were actually available to them in that specific moment. A fraternal order's dues book, a hidden mason jar, a feed sack and a needle, a single piano player who had to fill an entire room with sound using 2 hands. Nothing about any of these tools was glamorous. None of it was supposed to work as well as it eventually did. And yet it worked, repeatedly, across generation after generation, often without a single dollar of outside help, and frequently in direct defiance of systems actively working against it. That is the version of strength worth sitting with here. Not loud strength, not strength that announced itself or asked to be recognized in the moment it was happening. The kind of strength that simply did what needed doing, refilled the envelope the next payday, paid the extra dollar toward the mortgage principal whenever there was an extra dollar to spare, sewed the dress from the feed sack without complaint, and never once described any of it, using a word as dramatic as sacrifice, because to the person doing it, it wasn't sacrifice. It was simply Tuesday. It was simply how things got done. There is something worth understanding about why this particular kind of strength so rarely got its name spoken out loud at the time. Naming it would have sounded like boasting, and boasting wasn't the point. The point was always the next person, the next generation, the next dollar that needed saving, so the family standing behind you had a slightly easier road than the one you had just walked yourself. A grandmother who refused to buy something in a store window because she hadn't yet saved the full price wasn't performing discipline for an audience. She was protecting whatever came after her. A child's tuition, a funeral that needed paying for without warning, a winter that always arrived, whether anyone felt ready for it or not. This is also why none of these lessons end the conversation with anger, even though anger would be a completely reasonable response to nearly every single obstacle described across this entire list. The Freedmen's Bank should never have collapsed the way it did. The FHA should never have refused to insure black families on equal terms. Greenwood should never have burned. None of that is in dispute, and nothing about telling this story honestly requires softening those facts, or excusing the people and institutions responsible for them. But the people who actually lived through these specific moments rarely let the anger become the entire story of their lives, even when they had every reason to. They redirected that same energy somewhere more useful to the people coming after them, into a new bank account opened with whatever coins were available that week, into a garden planted the following spring, regardless of what had happened the year before, into a child sent to school with a homemade dress, sewn carefully enough that nobody outside the family needed to know exactly where the fabric had come from. The anger was real, and it was justified, but it wasn't where they chose to spend the bulk of their limited time and limited energy. They spent that time and energy building instead, because building was the only response available to them that actually moved their family forward, instead of leaving them standing still. That choice, build instead of merely survive the day, build instead of merely surviving the anger, is the actual thread tying every single lesson in this list together into something larger than the sum of its individual parts. It's bigger than any single mason jar or any single church building fund. or any single dollar that circulated through 35 blocks in Tulsa before the world outside ever got its hands on it. It's the accumulated weight of millions of individual decisions, made quietly, made without fanfare, made by people who in most cases will never have their names written down in any history book at all, choosing again and again to act as if the future was worth preparing for, even when the present moment was actively working to convince them otherwise. This is worth holding on to specifically because it isn't really a story about money, even though every single example in this list technically involves money somewhere. It's a story about what gets passed down inside a family that has very little to give in any conventional sense, and chooses, again and again, to give it anyway. A grandmother's penny saved becomes a grandchild's understanding that nothing should ever be wasted. A father's paid-off mortgage becomes a son's understanding of what it actually feels like to own something completely, with nobody else holding any claim on it. A great-grandmother's quilt, stitched from a husband's worn-out work pants, becomes proof, decades later, that the people who came before you were here, that they mattered, and that they built something lasting out of almost nothing at all. That is what gets carried forward in a family long after the specific historical circumstances that created each individual habit have faded into the past. Nobody alive today needs to know how to run a partner hand or sew a feed sack dress to still carry forward exactly what those practices were really teaching underneath the surface. Decide in advance where your effort goes. Protect what you build, fiercely, on your own terms. Never assume the world owes you an easier path simply because an easier path would be fair. And when everything gets taken anyway, because sometimes it will be, start again, exactly the way every single person described across this entire list always did. Before we move on, if you're enjoying this analysis, please consider subscribing. It helps the channel tremendously. That is the inheritance, not the specific dollar amounts, most of which were small by any modern measure. Not the specific tools, most of which belong entirely to a different era now. The inheritance is the decision itself, made over and over, by people who had every reason to stop making it and chose not to. And whoever is watching this, and recognizing their own grandmother, their own great-grandfather, their own family's specific version of this same exact story, carries that same decision inside them too, whether they've ever consciously named it or not. Lesson 25. The Credit Union in the Back Room. In 1918, a group of black farmers in North Carolina, shut out completely from commercial banks, willing to lend them money, pooled their own savings together, and formed the Piedmont Credit Union, generally recognized as the first black-founded credit union in the country. Each member bought a small share in the institution, and that pooled money became the seed capital used to make loans back out to members who needed it. No bank downtown had been willing to extend that same credit to black farmers on fair terms. So, the farmers built the bank themselves. This same pattern repeated itself for decades afterward, often growing directly out of a church, rather than starting as a separate financial institution from scratch. In 1936, in Richmond, Virginia, 10 black teachers walked into local banks looking for ordinary financial services and were turned away because of segregation. Rather than accept that, they pooled their own money and formed the Teachers Federal Credit Union, run entirely by and for the people who had been shut out. 2 decades later, when Martin Luther King Jr. and the Montgomery Improvement Association, the same organization that had coordinated the Montgomery bus boycott, applied for a federal charter to start their own credit union, regulators turned the application down, citing concerns that the membership pool was too broad. Despite that setback, black church-affiliated credit unions kept multiplying through the middle of the 20th century. Milwaukee's Greater Galilee Missionary Baptist Church started its own credit union in 1965, specifically because its predominantly black congregation was routinely denied loans, lines of credit, and basic financial services by mainstream banks in the city. The credit union still operates out of 2 rooms in the church's basement today, and its board members have said plainly that even decades later, qualified members still struggle to get fair treatment from banks outside the church, which is exactly why the credit union has never stopped being necessary. Here's how these institutions actually worked, day to day, inside the church. A trusted member of the congregation, often somebody the whole community already knew personally, served as treasurer. That person tracked deposits and loan payments by hand, sometimes in a simple ledger, kept in a kitchen drawer or a church office desk. There were no loan officers running credit checks based on a stranger's algorithm. The credit committee approving loans usually knew the applicant directly, knew their character, their work history, and their reputation in the congregation, and made lending decisions based on that personal trust as much as on paperwork. One credit union executive later described this approach exactly that way, saying people trusted each other more than they trusted outside institutions, because your neighbor was the treasurer, and you could see precisely where your money was going and who it was helping. This character-based lending model mattered enormously for a community that mainstream banks had spent generations refusing to extend the same trust to. A black church credit union didn't need a customer to already look wealthy on paper before taking their deposit seriously. The same instinct that had driven Maggie Walker to accept a 31-cent deposit on the very first day her bank opened decades earlier. The credit union simply needed to know the person was a member of the church, was known in the community, and could be trusted to repay what they borrowed, the same trust that had once kept a partner hand running smoothly between neighbors, with no written contract at all. By the 1950s and 1960s, as the civil rights movement gained momentum nationally, the number of these church-based credit unions grew sharply. Civil rights leaders increasingly recognized the credit union model as a direct, practical tool for building black wealth, since every dollar deposited stayed inside the community, got reinvested locally through loans to other members, and kept circulating rather than disappearing into an outside bank that had never served that community fairly in the first place. This tradition hasn't disappeared. In Dallas, Friendship West Baptist Church acquired a struggling credit union originally founded by another black congregation in the 1950s, specifically to keep that decades-old institution alive rather than let it close. The church built a small loan product through it called Liberty Loans, offering people with damaged credit an affordable alternative to payday lenders and auto title loans, the exact kind of predatory short-term credit that often traps borrowers in worse debt than the original problem they were trying to solve. One member, who had relied on payday loans for years simply because he didn't know of any better option, used the church credit union to start rebuilding his credit instead, paying back small loans on terms that wouldn't bury him further. In Brooklyn, Concord Baptist Church has run its own federal credit union since 1951, originally built to serve its own congregation during an era when redlining was not just common, but actively encouraged by federal housing policy. The thread connecting all of this back to everything else covered across this list is impossible to miss. A burial society collected dimes to cover funeral costs. A church building fund collected quarters to construct a sanctuary outright. A credit union collected shares and deposits to make small loans nobody else would approve. Different decades, different specific tools, the exact same underlying instinct. When the outside system refuses to serve you fairly, build the version that will, inside the one institution in your community that nobody can take away from you, the church. The same building where dues once got collected after Sunday service, and where, in some of these congregations, a member's deposit is still recorded by hand today, in a ledger kept in a drawer, by a neighbor who already knows your name. If you enjoyed this video essay, make sure to subscribe. Thanks for watching, and I'll see you in the next one.